Are you hoping to become a first-time homebuyer in North Carolina, but you just don't know where to begin or how you'll afford it? I love working with first-time homebuyers, and about a third of my buyer clients fall into that category. So I know a thing or two about getting newbie buyers into the homes of their dreams. And what I've found more often than not is that most first-time homebuyers just aren't aware of how much money they really need to put down or what options are available to them to help towards homeownership. So in this video, I hope to separate myth from reality and give you a little hope about achieving your goal of homeownership. But before we do that, a quick introduction. My name is Matt Martin, and I'm a Raleigh-based realtor. I've helped tons of clients, just like you, relocate to the Triangle region of North Carolina, and if you're looking to do the same, I'd love to help you too. Now, a quick disclaimer. This video is intended as an introduction to the topic of homeownership, but everyone's situation is unique. With that said, it's important that you talk to professionals in each of the areas we discuss. A mortgage lender, a tax accountant, and a real estate agent to best understand your options. And if you need any recommendations, drop me a message and I'd be happy to connect you. Okay, with that out of the way, let's talk about one of the biggest misconceptions out there that keeps so many people away from buying their first home. And that's that they'll need an insane down payment to qualify for a loan. Most people think you have to put at least 20% down to buy a home, but that's not always true. The reality is, if you're a first-time homebuyer, you may be able to put as little as 3% down. So on a $400,000 property, that's just $12,000. Way different than a 20% down payment of $80,000. Now, a few things to consider here. First, and this is an obvious one, but the less you put down on a loan, the bigger your loan will be, which means your monthly mortgage payments will be higher. Number two, the reason I think most people have this 20% down payment in their minds is because typically, if you put down less than 20%, you'll have to pay what's called private mortgage insurance, or PMI. PMI can vary anywhere from 0.5% of the loan amount to 2%, and it's paid monthly until you've hit at least 20% equity in your home. So some quick math. If you're buying a $400,000 home with 3% down, that means your loan would be $388,000. Let's say PMI is 1% of that loan amount, or $3,880 per year, which breaks down to $323 a month on top of your mortgage payment. Another thing to note is that these low down payment loans typically have qualifying restrictions for credit score, debt-to-income ratio, and purchase price. As of 2025, the maximum conforming loan amount is $806,500. So, speaking about down payments, let's talk about another big question I get asked all the time, which is, can I get any financial assistance as a first-time homebuyer? And the answer is yes, but it may not be what you're thinking. Back in the day, there were federal tax credits for first-time homebuyers that essentially equated to free cash giveaways. But as I'm recording this in February 2025, those no longer exist. However, North Carolina does have a few options to help out first-time homebuyers. The first is a program called NC First Home Advantage Down Payment. With this program, you may qualify for $15,000 in down payment assistance, but there's a catch. That money has to be paid back in full if you sell the home before 10 years. Then in years 11 through 15, it's forgiven at 20% a year and fully forgiven thereafter. The good news is, though, that it's a 0% loan during that period, so you're not paying interest. So let's say you buy a home and qualify for the $15,000 assistance, and then you sell it in 12 years. Well, in year 11, 20% of that loan would have been forgiven, or $3,000. Then in year 12, another $3,000 is forgiven, so you'd only have to pay back $9,000 when you sell the home. But if you own the home for 15 years or more, you're in the clear and you'll owe nothing back. Another interesting program that North Carolina offers is the NC Home Advantage Tax Credit. This program allows eligible first-time buyers, which is defined as anyone who hasn't owned a home as their principal residence in the last 3 years, and military veterans to claim a federal tax credit for 30% of your mortgage interest up to $2,000 per year for every year you live in your home. This means more money in your pocket, and it's money that you don't have to pay back. You can't beat that. Now, both of these programs have income and home price restrictions that change from county to county, so it's important to check with your lender to see if you qualify. For example, in Wake County, as of the recording of this video in February 2025, a single person must make less than $122,000 per year, while a family of 2 or more is capped at $140,000. And the programs only apply to homes up to $490,000. Okay, so I'm gonna make a bit of a 180 here. Another great way for first-time homebuyers to get into the market can be by buying a new construction home. Now, on its surface, that may not make any sense at all. Don't new construction homes cost more? Maybe, but a lot of developers offer amazing incentives, whether you're a first-time homebuyer or not, that can help make homeownership much more affordable. For example, I had some clients recently go under contract on a new townhome where the developer offered $15,000 in credits that they could use as they deemed fit. One way to use that money would be to help pay for your closing costs, which are additional costs that you pay at the closing table on top of your down payment to cover things like your attorney's fee, homeowner's insurance for your first year, title insurance, and various lender and recording fees. I have a whole separate video I made about closing costs that you can find right here, and I'm always happy to discuss them in further detail. In my client's example, their estimated closing costs were around $8,000, so they could have used part of the $15,000 builder incentive to fully pay for those at closing. This is a great option if you don't have a lot of extra cash to shell out at closing, or if you want to keep some money in the bank for things like furniture or eggs. But another option, and this is what my clients have opted to do, is to use that closing cost concession to buy down your interest rate. Now, this is going to get a little technical, but I'll try to make it super simple. When you get a loan, you can pay the lender to purchase what are called points to help bring down your interest rate. Every point costs 1% of the loan value and will typically drop your rate about 0.25%. So let's run some quick numbers so you can see just how beneficial this can be. Let's say the going interest rate is 7% and you're looking to get a $500,000 loan. Well, since points cost 1% of the loan amount, each point would run you $5,000 in this case, meaning you could purchase 3 points with that builder's $15,000 incentive. Now, if each point brings your rate down 0.25%, that would reduce the rate from 7% to 6.25%. So what's that translate to on your monthly payments? Well, at 7%, you'd be paying about $3,325 per month versus $3,080 per month at 6.25%, saving you nearly $250 a month and almost $3,000 per year. That definitely helps make the cost of homeownership much more palatable. Now, you can also do a hybrid model, use a portion of the funds towards closing costs and a portion towards buying your rate down, whatever best fits your financial situation and long-term goals. Okay, so these last couple things I'm going to discuss are a bit more niche, but they're great options if they pertain to you. The first is to get a gift to help with your down payment. Now, notice that I said gift and not loan, as they are treated completely differently by lenders. Obviously, we don't all have family members or otherwise who can help us out like that, but I've seen a lot of parents or grandparents who prefer gifting the funds now when they can see the fruits of their contribution versus in a will after they're gone. Now, different loan programs have different rules around this, so it's important to speak to a lender for more specifics, but I see this a lot, and it's especially become more popular in recent years as prices have increased. This next one's super specific, but there's a special loan out there for doctors that allows them to qualify with as little as $0 down. Yes, really. The idea here is that doctors generally graduate med school with large student debt that would otherwise inhibit them from qualifying for a loan. But they usually have high earning potential, and they're contributing to the public good. So these loans were created to help facilitate that home buying process. So you may qualify for a few of these options, but prices are still just too high and you can't stomach the monthly mortgage payment. In that situation, I suggest broadening your search radius, especially here in the Triangle. It's amazing how much prices can change when you head just a few miles outside the main downtown areas, and drive times may not be as bad as you think. For example, the median single-family home price in Cary is $700,000. But if you head over to Wendell, which is only 20 minutes east of downtown Raleigh, that median price drops to just $430,000. I made a whole video about the most affordable Triangle communities and cities, which you can find here. So those are a few first-time homebuyer tips and tricks that I hope give you some ideas on how you can start to dip your toes into the market. If you're ready to kick off your home hunt in the Triangle region, I'd love to be your guide. You can reach me by phone, email, or text, and you can find all my contact information in the link below or by scanning this QR code right here with your phone. And if you liked this video, I have a whole catalog of others all about moving to, living in, and buying real estate in and around Raleigh, North Carolina. Here's another one here that you may like, so give it a click to keep on watching.